I'm Mark Gagan, and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, now part of Sapiens, enabling an enterprise view of exposure. The growth of the portfolio solutions segment of the market has been one of the most exciting and interesting developments in global insurance in the last 5 years. The streamlining of placements in syndicated insurance markets is producing scale, speed, efficiency and cost benefits for underwriters, brokers and their clients alike. And this is a phenomenon that is really only just getting into its stride. Billions of dollars of premium are now being transacted this way as brokers look to facilitise significant percentages of their placements, while consortia and other underwriting pooling arrangements proliferate. As Director of QBE Portfolio Solutions, Tessa Wardle runs one of the lead markets for this pioneering form of delegated authority underwriting, and collectively, her small team underwrite on a scale that in premium terms is many multiples of that achieved by conventional market underwriters. In this podcast, we look at where this phenomenon is likely to be heading, as well as delving into the core mechanics of just how business of such a high volume is transacted in practice. What are the core skills of a portfolio solutions underwriter, and how do they differ from conventional underwriting practice? And what are the principal levers and controls that senior executives like Tessa have at their disposal to keep these huge contracts on track? It's a fascinating world that is in many ways revolutionary, but in many others, reassuringly familiar. Tessa is an excellent guest and one of the best qualified people to guide us through this huge change in global insurance business flows and give us an idea of where the trend will be heading as it matures. Enjoy the podcast. Tessa, welcome to the Voice of Insurance.
Thank you, Mark. Thanks for having me here. It's nice to see you again.
Really, really nice to see you because, yes, I first met you. It was a dinner where somebody had gathered together all of the portfolio solutions people, the brokers and the underwriters. That's where I first met you, and it was fantastic. So then I marked my card and thought, I've got to get Tessa on the podcast. Anyway, why don't you introduce yourself to anyone out there who doesn't know you?
Yep, sure.
And run us through your career to date. And this is a question we always ask each other, sort of, how did you get into insurance?
So I'm Tessa Wardle. I am the Director of Portfolio Solutions at QBE. So like most people in insurance, I fell into it. I studied maths at university and I had a placement year where I was an actuarial assistant at Aon.
You're kind of naturally inclined towards it. You don't accidentally get an actuarial placement, do you?
No, to be fair, I was trying to find a placement. I studied in Bath and I wanted to stay living in Bath. So there was only really one placement that was in Bristol. And this was the one role that was going, and managed to
get Bristol. I went to university in Bristol. I can testify that it's a very good place.
It's a lovely place. So I spent a year there and learned what an actuary does. This was actually a life actuarial, so it was all in pensions. And then after university, I wanted to go travelling, but needed a job to fund it. So I thought, actually, it would be really good to gain experience in something else. And I found myself an underwriting assistant role at Chubb for the political risk and trade credit team.
Oh, wow. Was that in London?
In London. So that was my introduction into the London insurance market. Absolutely loved it. Spent some time in Lloyd's, met brokers and worked with a really good team there. I then went off for my travels and came back 6 months later looking to start my career properly.
Where did you travel to, by the way?
Around the world, obviously.
All the way around?
All the way
Excellent.
around. So we didn't do South America. You have to choose between Asia or South America. And we chose Southeast Asia.
So you came back?
Came back and targeted the insurance market and found myself a role at Marsh as a broker in their energy team. So I worked on upstream, downstream construction business.
I suppose Marsh probably has most of the really big ones, the sort of big national oil companies of most big oil producing nations, doesn't it?
Yes, they had very, very large clients, global clients. It was a fantastic place to learn and work. And I got to see a lot and meet a lot of brokers and really gain that strong grounding in underwriting and broking. So I spent 7 years there, and then I joined QBE to run their energy liability portfolio. So I did that for 7 years. So I started underwriting, built lots of relationships, learned lots about US casualty business in the energy sector. And then I took up this role as the Director of Portfolio Solutions about 3.5 years ago.
And how did the solutions thing come about? Do you call it QPS when you're with friends?
Yep.
And, so it's QBE Portfolio Solutions, and then do we call it QPS from now on?
Yes, we always call it QPS. It's a lot quicker and easier.
As we know, your TLAs, three-letter abbreviations
yes,
on
we
the
love
market.
a TLA, yeah, absolutely.
So we shall call it QPS from here on in, QBE Portfolio Solutions.
Yes.
How did that come about? Whose idea was that?
I think it was quite organic. We wrote the first, cross-class broker facility, which is an Aon client treaty back in 2016, along with many other markets. We were just a follow market. It sort of sat there in the business. It had quite a few challenges in the early years. And then we took over the leadership in 2020 and made several changes, worked really closely with Aon to really turn it around and managed to make it quite a successful account. I think it was really then we saw the opportunity and the potential for this type of underwriting.
And what sort of scale have you got to? Just in how many people, for example?
I was the fourth person in the team to join. Since then, we've grown the team significantly and the portfolio. So we're now a team of 16 people. We have several headcount to recruit for this year as well, so we continue to grow. We are now split into two main portfolios. So there's a broker facility side of the business and then the MGA consortia play. We have a large market share on both sides.
What's your long-term ambition? Because when I read QBE literature, obviously QBE is a big public company with lots of documentation. QPS is described as a strategic arm of the business. So what are your long-term plans? So obviously this is something that's been decided. This is something we're going to do forever.
Yes, it's incredibly important to the business. And our ambition is to continue to be innovative in the way we approach underwriting and how we look at products and distribution and how we use data and technology to drive that. And it's clearly strategic for QBE as we've had a multi-year investment program looking at how we improve our technology and processes and also continue to grow the team.
And what's the big difference between writing a more underwriting-led facility on a consortium and a broker facility, of course, where you're pulling together a whole of a broker's input into the market and you're taking your share of that and sort of industrializing and scaling that up from individual risks into a portfolio? Is there a big difference
between broker facilities and consortia?
Yeah, because you're split into two sort of ways of looking at things.
Okay, so broker facilities are very much, you're looking to track the broker's portfolio, their whole portfolio. It's large, it's diverse, it's broad. You're looking to gain a small share of their book. When you start looking at MGA consortia, we use it as a tool to balance out our broker facility side of the business. So you can write, you're supporting market leaders in a particular area and often in a niche space. And they can then write risks 100%, which you take a small share of, which you can't do in a broker facility. So broker facilities don't work so well for risks that are placed 100%. In fact, they're completely out of scope.
The question that suddenly occurred to me is, I bet every broker says that their book is more profitable than everyone else's. Is that true? I mean, are some brokers better than others? And obviously, I'm not going to ask you who, because obviously that would be bad for both of us, I expect, if that ever went public. But is there differentiation, in the way that you talk to a big treaty underwriter and they say, right, well, actually, I underwrite the client, I underwrite the underwriter. I work with people that I'm really comfortable with and I really like the philosophy and everything about them. Can you do the same with the broker and say, I kind of underwrite the broker?
I think brokers are set up very differently. I think it's more the client base they have varies depending on what type of broker you are.
There's not really any such thing as a bad client for a broker, in that there are clients who are really difficult to work with. I suppose they're bad in that sense that some people are very, very high maintenance and some people aren't. As you know, some people are a dream to work with. But I suppose from a broker's perspective, more about how much work you have to do for each client. I suppose they'll define a client not on the basis of whether they're a bad risk or not. They'll just be whether they're difficult to work with or not.
No, I think for each broker, they'll have a different, portfolio, because some brokers will be better at certain classes of business or geographies or client size or industries. So their portfolios will vary. Doesn't mean it's a bad portfolio. I think you have to look at what their portfolio looks like. And obviously, every risk is underwritten by a lead market who will price the risk adequately, hopefully, with the right terms and conditions for that particular client.
We talk about this as being mostly a London market phenomenon, but certainly in the news the last, say, 6 to 8 months, I've seen some of the brokers, the really global brokers, starting to make these things more global in scope. Do you think that's something that's going to happen? Obviously, we're talking about it mostly as a London market thing today, because obviously the London market's a great place to do this because we're used to sharing risk, we're used to syndicating things, and we've all had consortia forever anyway, and broker facilities for a very long time as well now. But do you think the next phase is that this is going to go global?
I mean, I think it already has.
Because you're global, so...
Yeah, we're a global company, and all the risks that come into London are global risks. But in terms of some of the facilities, there already are a few that exist that are global, and I expect you'll see more of that in the coming years.
How big do you think the market really is? I don't know, if we look at our Swiss Re Sigma reports, we're talking about 7 trillion of insurance premiums in the world, or give or take a trillion or two, it's something like that. I mean, how much of it could be, I wouldn't say commoditized, but facilitized in this way?
It's a really difficult question. I think the potential is incredibly high. If you look at the LMA Enhanced Underwriting report that was issued at the end of 2024, they estimated that the potential for this market in 10 years' time was about $60 billion for Lloyd's. That was based on a Lloyd's market of 127 billion. So that's almost half of the market.
Yeah, because we've got up to about 80 something in dollar terms. Mm. It was 57.8, I think, billion in the annual results of Lloyd's this year. And I suppose we throw in the company market and there's almost double that.
Yes.
We're really getting there, aren't we? So what percentage share do you think it might be?
I mean, I think based on the report, it says it can basically go up to 50%.
And do you think 50 is probably the number at which it starts to topple over and it starts to not work? Obviously, you need a critical mass of leaders and potential secondary leaders and alternative leaders, because obviously every broker knows you're a broker. You know, it's nice to have an alternative leader because, one, it keeps the current leader more honest. And of course, you never know what's going to happen. You need diversification that's why we have syndication in the first place. Obviously, you know that occasionally your leader just stops doing whatever they're doing and leaves everybody in the lurch. And at that point, you would hope that you had a relationship with an potential alternative who could take over.
No, absolutely. I think there's an equilibrium between how many leaders you need to make a competitive market and then how much you can place as a fast follow capacity to make it efficient. The percentage, I think, will vary depending on the size of client and the class of business you have. We've spoken to quite a few brokers about this and what they think is an optimal percentage to be placed in the facility or fast follow. And there's really no consensus. I think it ranged from about 15 to 50%.
The broker, isn't it, ultimately,
yeah.
I suppose. And I suppose we'll see. The market will work it out. Is that your philosophy to say, well, the market will probably work it out? We'll work it out. Because, yeah, if it's 80, it's and you think this is unstable.
All brokers have a strategy on how they want to place the risk. So it will be largely based on what they think is right for that particular client.
And what about in terms of classes? We've already said, obviously, what doesn't work is if a risk is written 100%, I can see why the logic. Of course, there's nothing left to share. So you can't place any more because it's already been placed. Do you think there are any classes that just inherently not suited? Or I suppose, is it just a law of large numbers? The number has to be large enough. If the class is too niche and too small and potentially unstable, does it mean that it can't really be facilitized because it's not a big enough number yet?
Yeah, I think there is something in that. You need scale for a portfolio to work.
If it's like fish farms or whatever, I always fish farms, I don't know why, but just think about things that are very particularly niche and maybe not huge numbers, and then a couple of really bad, unlucky losses in the same year could wipe everything out.
Yeah, you tend to have, for broker facilities, it's, specialty market, large risk, which is, you need, syndicated co-insurance business. What we do is build a portfolio so you can bring in some of the smaller classes of business, which is balanced by the larger classes of business. Some classes are just more difficult to get the right level of indexation because some of them are already heavily facilitized, or some of them may be to do with just aggregate management, might be quite difficult. So something like credit lines. Doesn't mean you can't do it, it's just a bit more difficult and you need a few more controls and it may or may not suit that facility.
That's really interesting when you've mentioned indexation there and aggregation, obviously things that you worry about. I suppose, when your boards are saying, great, love what you're doing, this is fantastic, really interesting. But I suppose the things that they need to know that you're definitely on top of will be, one, aggregation. And what do you mean by indexation? It'd be nice to go into the mechanics of your day-to-day of how do you make it work? Does it occasionally mean that there's a genuine correlation between, let's say, marine hull is running at 43% loss ratio, you would hope that the portfolio that you construct by signing up for those marine hull facilities would then produce a similar number for you?
Yes. So indexation is basically the same as anti-selection, or how you remove anti-selection. It's how well you're indexing a portfolio.
Is that the intent? Ultimately, it's not like you're a fund manager trying to beat the market by being slightly clever, being slightly overweight here and underweight there. Or I don't know if you do that. When you look at, the stock market, you look at fund managers, an active fund manager. Are you an active fund manager, or are you more like a passive fund manager, like a tracker?
It's more comparable to a tracker. We obviously do set some parameters, we do shape the portfolio, but we're largely looking to track the broker's portfolio.
Yeah. And because that's hard enough, I presume.
Yes, exactly. And so the indexation metric is about how well are you tracking that? And that was introduced years ago to monitor that, because I think the older days of broker facilities is where there was a lot of anti-selection, where you was often just being selected against and only
Well, it's just like dumping the facility because we can't place it anywhere else.
Yes. So this is a way of measuring it.
Yeah, and these days, I suppose most of those facilities, if it's in scope, that share has to go in. Is that the way it works generally?
Every facility is different and how brokers run it is different, but the aim is that they're all in scope and it all should be taken up. But obviously it is ultimately the client's choice whether they want to use it or not.
So there's not like an LMA wording, like LMA Portfolio Solutions 137 or something that you all use?
Well, not yet anyway.
Well, you probably could get one. I mean, this is on the market. We're bound to end up with a wording.
We have released a sort of guidance on indexation just to create some common terminology and how we measure that.
That's really interesting. And then in the mechanics, do they have to set up an MGA technically? And that's how it works,
yes.
Even though it's sort of, you're delegating your pen, but you're not really.
So we delegate to the cover holder, which will be owned by the broker, but it's segregated. They are underwriting on our behalf. But obviously, we've been very specific about what they can and can't
Their
write.
authority is basically do whatever Tessa says.
Yes. Yeah.
No, I like that. So it's incredibly strict because effectively you're doing the underwriting. You are accepting this, although you've delegated. This is the technical arrangement. That's how it actually works. It is an MGA underwriting on your behalf.
Yes.
That's really interesting because we talk about these things, but we rarely talk about how does it actually work mechanically. What is the placement method? So it's an MGA ultimately.
Yes.
Something that people always say, facilities, they work very well when the market's hard and very profitable for everybody. It's a great way of distributing those profits around. But then when the market gets softer, they get harder to maintain. And let's say pre-2015 facilities, we've all been there where, they sort of fall by the wayside as the market gets more competitive because they just tend to lose money. How will you solve that problem? Do you think there's a way that this will be different this time?
I think so. I think it's all about how we monitor and manage the portfolio. We're always looking at the metrics, looking at what's going to portfolio, looking at what the market's doing. And there are adjustments we can make. We always want to work with partners who see this as a long-term solution, and so who will want to work with us to make sure that they are viable long-term and throughout cycles. Do
you think it's partly because it's the advantages also to the broker and then ultimately to the client, that the broker will want to keep the thing going at all costs because, one, they've probably invested quite a lot in themselves, their own technology, their own management of this method of placing a large percentage of their portfolio, and they're seeing the cost benefit of doing it that way, i.e. their brokers become more productive because they're busy doing the difficult stuff and getting new customers and quoting new business, which again is going to be a virtuous circle that they get that benefit. When I talk to a broker, they'll say, you know what, we'll do everything in our power not to lose these facilities now that we've got them because they're so useful. Do you think we've got enough kind of common incentive, that you've got mutual benefit?
Yes, I think we're kind of aligned in both capacity and brokers want these to be long-term. They're selling this to their clients as a long-term solution and are benefiting through the efficiencies and making savings for them, for clients.
Because they're getting a lot of now featuring a client rebate.
Yes, exactly. So benefiting by the efficiency of the placement. When you really want the capacity, it's during a hard market. If you don't have your facility during a hard market because you burnt it during a soft market, that's not particularly great. So I think people are looking at these as much more long term. If they can be successful through a soft cycle, then they will be there for a hard cycle, which is what's really important to clients and the brokers.
How many people in your unit?
16.
And obviously we can't talk about how much premium they're doing, but let's say premium per underwriter is higher. Well, it better be.
It definitely is higher, yes. We have obviously a lot of support.
Facultatively, people doing risks one by one or treaty by treaty. So that means obviously you're very, very efficient compared to another form of underwriting. Does that mean that logically you can work to a lower return hurdle on capital? And is that partly sort of that's what's built into the model as well from your perspective?
So our return hurdles aren't any different from our traditional open markets, but what we do benefit from is just our diversification. So we might benefit from capital allocation.
So so you can do more with less capital.
Yes,
and so that makes you more efficient. But you're still trying to make the same sort of pure underwriting profit, or at least what that market is on average making.
Yeah, we do benefit, from a low expense ratio in our open market, but then we are obviously paying additional commissions to run these. So it often offsets the benefit there.
Presumably not all of it. But the real benefit is the capital benefit. You've got this instantly wonderfully diversified portfolio with by class, by geography, and it couldn't be any better in that sense, I suppose.
Yep.
You support Key in the marketplace. Would you think, as you demonstrate your skill in portfolio solutions underwriting, will you do something similar to them? Invite others to come and join in and say, why don't you work with us? If we've become the experts at this, you're recognised as one of the leaders in this. Probably with Key together, if we ask anybody, you're leading many of these broker facilities. Would you consider doing something similar to what Key's done, i.e. offering your underwriting prowess in this as a service to maybe capital providers or other underwriters?
For us, it's great to be a recognised leader, and when new opportunities arise, we're the people you go to, and we have the support of many of our peers in the market, which is fantastic. In terms of third-party capital, it's not something we're currently thinking about, but I wouldn't rule it out if the right opportunity came along and it happened to align with our strategy.
What about people? When I got off the train today, there was a little robot cleaning the platform, and it was slightly disconcerting, but it was quite a cute little robot, and it was doing a very good job. I was thinking I felt sorry for whoever the cleaner, is not getting that sort of £12 an hour job, being taken over by the robot. But in terms of the people side of the business, is it still really important? Do you just come in and press 3 buttons and then, go and have a coffee or something? Is the human side of it still as important as it ever was?
It's always going to be important. I think in insurance, we're always going to be built on relationships, and it's to do with our cover holders, our clients. We look for strategic partnerships that we can work together long term and grow together. And in terms of our staff, they are incredibly important to us. And I think it's about using technology to bring better tooling to them so they can do their jobs more efficiently and more effectively.
One thing I saw, I think it was Key actually, it was what I found amusing, it was a couple of years ago, it was posted on social media of, here's our golf day. And I was thinking, well, good, made me feel quite pleased that, I know that there's all this technology and algorithms and clever things going on, but it was nice to see that it was still human beings who were being hospitable to each other and taking brokers out for a round of golf, which I thought was, that was rather nice. What about your underwriting skills? When you're getting underwriters, a bit like yourself, and you've come from broking or underwriting a particular class of business, becoming an expert in particular types of risk, and then thinking, well, I want to join Tessa's team because this is going really well and it's really interesting what they're doing. What's the main kind of change in skill or new skills they have to learn when they come over?
So portfolio underwriting, it requires a broad skill set from traditional underwriting, delegated underwriting, portfolio management, data analytics, actuarial pricing. We have a quite diverse team of underwriters who've come from different backgrounds, but a lot have come from a traditional monoline. So the first thing we tend to do is obviously build up their knowledge for other classes of business, because we write cross-class, but also to understand how you look at things from a portfolio perspective, opposed to a single risk perspective, and also look at using our data analytics tools to help monitor performance, things like that.
So they're much more becoming more like a CEO, like a chief underwriting officer type job than they are anything else. And what tools and levers have you got at your disposal? Because at some point you might think it's actually quite a blunt instrument, because literally it's a binary thing. You say yes or no once a year to this broker facility or that broker facility or this follow form with a consortium that you join or you could leave. Are there any sort of tweaks you can make? I always think of the sort of, the Bond villain Blofeld with a big sort of control panel with all the different buttons you can press and the thing to make the trapdoor open, and then but tweaking. And is there sort of, dials that you can dial up and dial down while you're actively during that 12-month period? Is there any underwriting activity you can do other than just say yes or no?
Yeah, so for the broker facilities, and especially as the leader of many of these, we have a lot of controls, and we are constantly in dialogue with the broker monitoring what's going in, what's working, what's not, and making adjustments where necessary to improve either the indexation or anything we're concerned about.
Yeah.
We have a very good close
business accumulation stuff. You can say, wow, why are we suddenly getting really overweight in Japan on this? You've got those kind of almost real time sort of data, and presumably your data flows are very good, so you know what's going on.
Yes, so we have vast amounts of data, and our cover holders will, model the data for us. We'll model it again, and we've got various dashboarding, sort of ingestion tools, stitching tools, so that we can monitor the performance.
So it's a kind of constant. You've got somebody on the opposite side, you've got someone in charge, and if it's a consortium, there's a lead consortium market, and you're in dialogue with these people all the time, I presume.
Yeah, it's all about having a very strong, good working relationship with our cover holder.
And I suppose some are better than others, and presumably some aren't as responsive as they should be. And you think, well, actually, I'm going to put that down. We need to resolve that. Otherwise, I suppose you can become more comfortable with some people because you have a really good dialogue and they're really responsive and you're all on the same page, and others are less responsive, I presume.
Yes, it's all about the relationship.
So you've got to spend a lot of time chatting and on the phone with all these partners and these stakeholders.
Yeah, we spend a lot of time meeting face-to-face. It's preferable, but online or through calls.
So it's pretty sociable.
Yeah, it's still very sociable. There's still a lot of socialising. That's how we met. So
yeah, but you can really bury yourself behind those multiple. How many screens have you got on your desk?
I've only got one screen, so it's a very large one.
I just had a thought that a bit like a trader, you'd have at least four. They always have the Bloomberg one and the charts and the whatever. So it's not having this huge stack of sort of.
No, we have, we have all the dashboards we've built and the tooling, and we've got people within our team who work specifically on the data. And then we look at all the insights, and we have various meetings when we look at various things. But underwriters use these tooling day to day when they go and, speak to the cover holders about the portfolio, anything they're worried about or want to dig into.
AI, we can't be sitting here not talking about AI. It's one of the questions sort of popped up about 2.5 years ago that became one of my sort of compulsory questions. I have to ask everyone about what they're doing with AI. And obviously it's evolving a lot, because 2 years ago it was easy for everyone to say, yeah, we're trying a few things out. And now it's really moved on. So you've tried out lots of stuff, and what stuff's worked and what hasn't worked. Presumably you couldn't have a better use case application for AI because you've got streams of data, whole portfolios of data, and you're blending them all together. So even better. What's been the best AI use cases for you?
We're very excited about using AI, and it's going to play a larger role as we go forward into the future as it develops. For us, we have vast amounts of unstructured data. We have to stitch lots of data together. We have to cleanse it, enrich it. There's a whole lot of work just to get to foundational level of, so we can provide some good insights. We've tested some AI tools that will help assist that. And I think going forward, they will just play a bigger part there to make it quicker and deliver better insights for underwriters.
It's really about structuring the unstructured and making things comparable with each other.
Yes, exactly. Because you know what data is like in insurance.
Apples and pears and bananas. And then, and they're all put on the same chart. And
yes.
Well, obviously, it's partly the broker's job to compare apples and pears, and it's for you to say, no, that's an apple and that's a pear.
Yeah, absolutely.
If pears are going cheaper, then you want to pretend that all the apples actually are much more pear-like than most of the other apples out there. Obviously, the other thing, when we're talking about AI, is agentic AI that goes and does things on its own. How far do you think we'll end up? Could we go with this? Could you remove the human?
I mean, I don't think we'll ever remove the human in terms of underwriting and many of our processes. Like I said, I think it's providing better tooling to them. So making some of the simple jobs easier, quicker, more efficient. So it's just giving our staff the skills and tools so that they can actually do their jobs better.
So, you don't think you'd ever be removing, we would talk about the human in the loop. That's never going to happen. It's very unlikely to happen. And again, it's not as if there's a huge cost saving if there's only 16 of you anyway.
To be fair, I don't think...
So 17,000 of you could all be sort of made redundant at a huge saving.
Yes.
You're kind of quite lean already.
It may benefit the cover holder who's in scoping hundreds and thousands of us. I know that most of our cover holders use new technology to help make that more efficient, but I think it can certainly be improved as technology advances.
I've come to the end of my list of questions, but do you think there's anything we should have spoken about that we haven't spoken about, or plans for the future or whatever? It's such an interesting topic, and I could talk about it for hours, but I'm just wondering if there's anything that I've missed out that you'd like to say.
I don't think you've missed anything. I think it's a very exciting space to be in. It's a way of being more innovative in a very traditional industry. And I'm very excited about the future.
I suppose as the technology gets better,
yes,
the data you're going to get gets better, and hopefully it'll become more structured from the brokers and from the client originally. Yeah. So would you say that your skill at indexation is just going to get better?
Yes, we've already seen technology help a lot in this space, and I think it would just continue to improve. So it would definitely benefit us in the long term.
Is that how you're generally incentivized? Are you incentivized to make sure that you hit the mark in terms of, making sure your loss ratio is pretty comparable to where it should be, where you're expecting it to be?
Yeah, I mean, we price every single risk actuarially using our data and the data that's provided to us. So obviously it needs to deliver a certain level of returns, and that's what we aim to achieve. Really good.
So you're still pricing every risk?
Yeah,
individually
in a portfolio, at a portfolio level.
Yeah, right. So you're going, right, this risk within the portfolio doesn't seem to be quite right, or you're only looking at the average.
When we price the whole portfolio, and our data capabilities will at some point we'll be able to get to the risk level pricing, which will be fantastic.
One thing I was going to ask you, which wasn't on the list of things I was going to ask you, is what about your own outwards reinsurance? Do you sort of automate that, or how does that work? Can that be automated, or is it something you can't talk about?
Well, I mean, our reinsurance is run by our outwards reinsurance team.
That's all done at group level?
We're very involved, but it is done as a group level.
But I suppose those reinsurers benefit, again, from all that data you've been able to get, and they presume it must make them quite happy. And of course, they should be happy because they're reinsuring something that's incredibly diversified.
Yes, absolutely. And we, have a very good track record.
So it's pretty predictable from their perspective. Well, you'd hope so. At that level, unexpected things shouldn't make big ripples.
Yeah.
Thanks very much for that. I've got to book in time in the future to talk to you because everything's moving so fast. That's what's really exciting.
Yeah, absolutely.
So, yes, Tessa, thanks very much for being on the show, and we'll speak soon.
Thank you for having me.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.